Stock market news can be frightening. We see headlines like the Dow Jones plunges 500 points. The S&P 500 is expected to drop 20% in the coming months, and Tesla suffers its biggest one-day drop. This type of news can scare away seasoned investors. And as a new investor, it can definitely make you pause and think, is investing even right for you? And this leads right into mistake number 1. You are not investing. The volatility of the stock market and the media can paint a very scary picture for you. You could be keeping a lot of your earnings in cash. Cash gives you a sense of emotional and financial security like nothing else really can. Some people even keep cash at their house, even hidden under a mattress. I definitely recommend keeping a 3 to 6 month emergency fund in cash. That way it can account for any unexpected bills that come up. Maybe you got laid off, or you have a car repair, or a medical expense. That'll help take care of any necessities in which you need immediate cash to resolve. However, if you're keeping excess cash, that is not a smart move for your money. Inflation actually causes your money to lose more than 2% of its value per year by keeping it in cash. So $10 today will not be able to buy you the same thing 10, 20 years down the road. Future you is going to ask present you, why didn't you start investing earlier? You'll want to put your excess cash in investments that generate at least 2% return. That way you can at least beat inflation at the bare minimum. So yes, headlines like the S&P 500 plunging 20% can be frightening and is a great demonstration of the day-to-day or month-to-month volatility. And you will see your investment roller coaster up and down and in the red on certain days. But what's more frightening is that you don't start investing today and your cash becomes worth less than it did 5 years ago. In the long term, the market is an upward trend. So don't procrastinate. Give your money the opportunity to grow. Mistake number 2, investing in companies you do not fully understand. One of my biggest personal investing mistakes was investing in a company I didn't understand. In my freshman year of university, I worked part-time and managed to save a little bit of spare cash to start on my investing venture. One of the companies I invested in was based on the news outlet mentioning that oil prices were going up and up and up, and oil is a limited resource. I assumed because of the prices skyrocketing and oil being a limited resource, an oil company could be a great investment. I did not, however, spend the actual time needed to research and look into the company to decide if it was a worthwhile investment. I was simply speculating on the idea that because of all the prices of oil climbing up, that the company would be making lots of money in the future, but that wasn't the case. It made sense to 18-year-old me, and I ended up losing a lot of money on that particular stock investment. What it really was not an investment. It was just pure speculation. Things changed really quickly in the past decade as people pushed for more eco-friendly products, things that are more related to electric, solar, wind energy, and companies that are more aware of being eco-friendly. In addition, in the past decade, a lot of major oil producing companies decided to raise the limit of the amount they were going to produce. And that caused an oversupply of oil, which dramatically dropped the prices. In that case, the oil company that I invested in couldn't keep up with the changing market. What I learned is that it takes a lot of time, hours and hours of research on the individual company. And then even after your initial stock purchase, you have to keep up with the market news and news on the company to determine if it is an investment worth keeping. You have to understand the company's competitive advantage, whether it's a strong brand like Nike or Adidas when it comes to athletic and sports apparel, or intellectual property, like patents for drug manufacturers that gives them exclusive rights to sell a particular drug product and get those profits over a certain period of time. Or economies of scale like big retailers such as Walmart, which essentially allows them to price out other competitors and provide a high barrier of entry for competitors into the market. And whether that competitive advantage is something that will allow the company to prosper in the next 10, 20, and 30 years. In addition to that, you have to do a fundamental analysis on the company's financial strength. Has the company been profitable in the last 5 years? Will the company continue to be profitable in the next 5 years? Does the company have a lot of debt? Will it be easy for the company to pay off its debt? This is a bit outside the scope of this video, but looking at the income statement, cash flow statement, balance sheet, and other financial ratios are crucial to understanding the financial standing of the company, especially when you're comparing it to its peers and if it is a worthwhile investment. If you're a beginner, you're probably wondering, how would I be able to invest then if I don't fully understand the company? Or I don't have the time to do the research to understand the company? The answer is through index funds. Index funds are a great way to get started investing safely without spending the hours of research on individual stocks. Index funds are a great way to create a diversified investment portfolio that's able to grow your money big time over the long run. Research has shown that index funds beat 90% of actively managed funds. These are funds that are managed by people who spend their entire full-time job researching stocks. If you were to invest in the S&P 500 index, an initial investment of $10,000 in 2010 would be worth over $30,000 today. While past performance is not an indicator of future performance, the stock market has in the long term always been on an upward trend at an annualized real return of about 7%. Obviously, some years it may drop 15, 20, 30%, but over a long period of time, it has generated a real return of 7%. Your money invested at 7% return generally takes about 10.2 years to double its value. The bull run in the past decade has allowed money invested from 2010 to triple by 2020. Mistake number 3, not taking advantage of tax advantage accounts. It is important to consider taxes, as everyone's required to pay taxes and taxes can take out huge chunks from your investments. To help reduce the burden of taxes, tax advantage accounts offer a great benefit. Just by investing in the right type of account, a tax-free account like the Roth IRA, 401k, or HSA, you'll be saving a bunch of money on taxes. Usually you have to pay income taxes on your interest or dividends, plus capital gains taxes on any profit from your investments. And depending on the tax rate, you can pay anything up to 40%. That is a big chunk of change. Just by investing your money in a tax advantage account, such as an IRA or 401k, you are saving a lot of money immediately. Make sure you take advantage of your tax-free accounts, such as the 401k, HSA, and IRAs, before you use an individual brokerage account. Try not to have a lot of your investments in your traditional brokerage account if you have not first maximized the value from your tax advantage accounts. So common accounts today, such as Robinhood or Webull, seem to entice a lot of new investors and beginners to use them, but make sure you're taking advantage of those tax-free accounts as well. That's it for my top 3 investment beginner mistakes. I've made all these mistakes along the way as well, and hopefully hearing some of those pitfalls that I've run into can help you on your financial journey. Start investing today for your financial future. Thank you for watching. Hope you enjoyed the video. If you did, go ahead and hit the like button, subscribe, and hit that notification bell to notify you of new videos like this every week. If you have any other questions or comments, feel free to leave them down below in the video, and you guys have a good one.